When people are ready to trust the guidance and intuition of other people on finances based on their financial results instead of financial institutions, like the banks, then you know there really is a fundamental problem.
That's a problem.
In our video today, we discuss how the big banks are sponsoring wrong financial education that only has one goal in the end: to keep you poor. The whole financial literacy bandwagon, as promoted by the banks, does not necessarily teach what is true. Financial literacy typically began as an outreach movement undertaken by commercial banks to meet the requirement of the Community Reinvestment Act. For some banks, the aim has been to help lower to middle-income families, especially in deprived communities, understand money and how to manage it to make informed financial decisions. Every few years, the Financial Industry Regulatory Authority, FINRA, issues a short financial literacy test as part of its National Financial Capability Study to measure consumers' knowledge about interest, inflation, diversification, bond prices, etc. The study in recent times, however, has shown that there is widespread illiteracy because just over a third of respondents got 4 or more questions out of 5 correct. What then are the banks getting wrong in their promotion of financial literacy? The first way banks are sponsoring wrong financial education is by overemphasizing the math of money. The mathematics of money does not assume that people have any particular level of math experience other than the ability to do basic arithmetic calculations with the aid of a calculator. The math of money generally assumes that the better people are at solving math, the better they will be in managing their finances. This cannot be more wrong. Some research even suggests that people who are better with math are more satisfied with their lives. Financial capabilities and management certainly extend beyond basic mathematical calculations, which most people are good at. Creating the assertion that sprucing up your math skills means you are financially literate does not solve problems like which kind of investments will be good for you, how to make interest on your savings, and diversifying your financial portfolio. If you think that the math of money solves financial problems, then you may not have been exposed to the harsh realities of financial management, which we will discuss in a bit. Secondly, how do we measure who really needs financial education? Most banks target their financial literacy programs to lower to middle-income households. And while financial education is meant to be inclusive, in reality, it is not and is usually presented as exclusive for all the wrong reasons. Researchers in Australia and the US have found that some indigenous communities associate wealth and success to shelter, food, and a strong family network rather than loads of money in your bank account or humongous net worth. As such, how do we really dictate where to shift financial education and who really needs it? If you look at it, middle to low income earners have less resources and therefore less to overlook. The issue of financial management cannot be discussed while negating the conditions of extreme poverty. How to manage their cash flow, how to ensure that their daily needs are met, how to deal with emergencies, and how to raise large sums of money when it is needed are all poignant questions asked by the poor who do not have the luxury of following widespread financial education, tips like savings and investments. Conventional financial education assumes that people should aim at expanding their returns, but the poor have a more fundamental need of sustaining themselves. They do not have the luxury of making sound financial decisions when the burden of how to meet their daily needs has not been lifted. Banking products, which are inadvertently supposed to help the poor with managing their finances, do an even worse job. But before we go into detail, make sure you hit that subscribe button down below. Then again, unless a person has a stable income in the formal sector, they are unlikely to have adequate funds for retirement. Financial education programs like budgeting, appropriate financial instruments, savings, etc., do not make strategic sense to people in the lower income bracket because of uncertainty. What we are saying is that financial planning, as espoused in the financial literacy program, may be overlooking the fact that the poor are more likely to be good at budgeting, but it may not prove to be enough for them to count as financial literates because their source of income is low. Informal saving mechanisms are also unpredictable and high risk. Banking products are meant to be financially inclusive, meaning that individuals and businesses should have cheap and easy access, but that is not always the case. Individuals on low income may be adversely affected by financial products because they rarely hold mortgages and lack the minimum bank balance for fees to be waived. Banking products are not always cheap to access, and though financial inclusion is meant to make these products accessible, it is not always the case. Everyone talks about the importance of financial education, but are the banks doing a good job with the kind of financial education that is being sponsored? Tell us your thoughts in the comments section down below. Thanks for having us. We'll come your way again and enjoy the rest of your time.